Good day, guys, and welcome to yet another weekly wrap from Rand Swiss. This week, as always, we'll cover what happened in the week and how it likely affects your investments. Of course, the big news of the week was the US inflation number, which came in at 9.1%, shockingly high, higher than anyone had been anticipating. At least any of the major analysts out there have been anticipating. I think the highest number was 8.9, consensus was around 8.7. So we saw a surprisingly high number, driven by the usual, candidates, food, energy, housing, etc. If you looked at the core number, the core US inflation number also came in higher than expected, but it's off the peak at least. So core inflation peaked a few months ago, whereas actual inflation, the full CPI number, has been going on for a little while longer. So this 9.1% is the highest number we've seen in 40 years, and it obviously is quite shocking to the market. When the news came out, the chance of a rate hike of 0.75% at the next meeting basically became almost a certainty. And in fact, for a time, the market was pricing above a 0.75% rate hike at the next meeting. I mean, there's a chance that people are looking at 0.75 or up to 1%. Now, I want to discuss in a second a possible scenario around US interest rates and why we might be seeing a move from the gradual rates we've been seeing recently to something more aggressive. But looking at what the inflation number really said, like I said, the core number was really basically coming down, surprisingly up on the side, but it's coming down, showing that the underlying inflation rate, excluding things like food and energy, remains high but on the downward track. Energy should also be coming down reasonably soon, and so should food probably, because if you look at the commodity market, we saw energy prices, that's the price of oil, for instance, coming down quite substantially from the highs, about 20% or so. We also saw what's called the cracking margin. So when you take oil, you don't just use oil from the ground. You have use petrol, use paraffin, use all those things that come from oil, and that has to be processed in a way. And obviously the refinery takes a cut, a profit for processing these things. And so what we are seeing is the margin for that blew out to huge levels. We're talking like 3 times almost what the normal level is. Briefly for the last couple of months, there were issues around refinery capacity and so on, allowing refiners to charge a lot more. That's also come down, again, not to historical levels, but from the all-time highs, it's down again. So we have seen oil prices come down, we've seen refinery margins come down, so that should translate to cheaper gasoline in the US, which would mean that there'd be some kind of lack of pressure coming through. We've also seen food prices come under a bit of pressure as well. Commodity prices, wheat, soya, corn have all come under some pressure. They're well off their highs recently, and they are basically down to where they were before the start of the war in the Ukraine at the end of February this year. The same thing is actually true with petrol as well. So with the petroleum as well, with crude oil, it's basically down to where it was around about the time the war started. Now, these were obviously high levels, despite what President Biden says. It's not the Putin inflation or the Putin, price crunch or whatever it may be. There was already built-in inflation in the US system, the global system, and this just basically pushed them over the edge. So what we are seeing is those factors coming down. Countervailing, there is a concern about housing prices. The way the US includes housing prices in CPI is a bit confusing. Housing prices and housing related costs account for about 30% of that CPI number. But it's not done in a way that you would think it would be done when people do a survey about what's happening here. They kind of like ask people, if you were to sell your house or rent your house without furniture, what would you get for it? That kind of stuff, which is an unusual way of doing things. It's not an actual measurement, it's more of a survey. And that basically usually has a bit of a lag. So we might still be seeing housing pressure prices, for the next month or so, which might just keep, inflation higher than we'd want it to be. But I would think that, that will also come down because we are seeing, people really coming under pressure. US mortgage rates are rising substantially. People are going to have real trouble servicing their loans, and there's probably going to be more supply of houses onto the market. That's probably going to be a drop in prices, and probably also going to mean a drop in, rentals maybe, or whatever you want to call that little measure they use to work for CPI. So, in all likelihood, inflation is peaking this month or next couple months, and will come down. It will not come down anywhere close to that 2% number anytime soon. That 2% number is what the US Fed targets. That's not going to be happening. But we are going to see a bit of relief come through. And here is the danger. What the US Fed may be tempted to do is when it sees inflation come down a bit, say like from 9.1 to say 7 or 6 even, what it might want to do is start looking at cutting interest rates. And in fact, the bond market is actually looking forward till next year as being the first time that the US Fed is possibly going to cut interest rates. We're talking about first quarter of 2023. Fed guidance says the first quarter of 2024 is the first time we're likely to see a rate cut come through. So it's a year difference between the market and what the Fed is saying. Now, I think that the market is getting this wrong at the moment anyway. The Fed, I think right now, is possibly contemplating some aggressive action. Why? Now, you must understand that the way the Federal Reserve basically controls interest rates in this kind of environment is by making the economy contract because of the fact that demand is too high. I know it's not just demand stimuli, there's supply issues, blah, 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 but the only control the Federal Reserve has, and the Federal Reserve is supposed to control inflation, the only way it has to do that is to cut demand. And the way it cuts demand is by basically raising interest rates to make people do less stuff. What's been happening is that people are not believing the Fed. I didn't believe the Fed, quite frankly. But if it was only me, not a problem. If everybody's not believing the Fed, what does the Fed have to do? Be stronger. The fact of the matter is, it seems that I was consensus. I wasn't, an outlier in thinking the Fed is probably going to cave sooner rather than later. The bond market's saying the Fed's going to cave sooner rather than later. The Fed cannot allow that to happen. Why? Because if it loses that threat, it's like the threat of interest rates is one of the controls the Federal Reserve has over the U.S. economy. It's this major control it has over the U.S. economy, quite frankly. And if it loses that threat, that the credibility, the market basically will disregard its interest rate hikes, and we could see inflation get really out of control. So to preserve that, the Fed may have to basically show some power. Just imagine like you threatening somebody, and you basically, after a while, the person gets used to the idea of threatening them, and they don't listen to the threat. What you have to do, you've got to basically take some action and basically back up that threat in order to make the person start believing you again. The same thing applies here. The Fed is threatening the market with high interest rates to lower growth. The market's not believing it at the moment. We see unemployment numbers at very low levels. We still see demand in the economy being reasonably high. We still are seeing projections for rate cuts in the first quarter of next year. The Fed may be forced to go and do an aggressive move. So don't be surprised we see not just basically a 1% rate hike, but maybe a series of them. And there's even a possibility, small possibility, that the Fed may decide to push towards doing more than 1% hikes because, quite frankly, they know where they need to be. Gradually getting there may not work, especially if the market interprets the gradual move as basically a lack of commitment. If the market basically saw maybe a more aggressive move, that might actually make them act quicker, and that might actually bring inflation etc. under control earlier. So this is not by any means a consensus move. This is definitely a very out there, but I've seen some economists that are not mainstream but are respected talk about the possibility of the Fed actually acting in a more aggressive manner than it is right now. But like I said, you should be expecting a 0.75% hike to maybe even a 1% hike in the next Fed meeting. Other news out there, the European Union, like we mentioned a couple of weeks ago, is actually sucking up basically natural gas around the world because they have more money. Evidence of this, Pakistan recently put out $1 billion tender for natural gas, got no takers. Nobody wanted to sell to Pakistan. Why? Because they get more money from the European Union. And the European Union right now, for the first time in a while, is basically being forced to take up long-term contracts at these incredibly high prices because they want to guarantee their supply. And suppliers basically say, you want to guarantee it, take a long-term contract with us. And the European Union is going out there and taking long-term contracts to basically try and fill up their gas storage at incredibly high prices. Places like Pakistan, places like India to a certain extent, places like China, really can't afford to compete on that level. On a per capita basis, the European Union has way more money than anybody else, except for the Americans and the Japanese and the Australians. But I mean, they definitely have more than the Indians or the Chinese and the Pakistanis and so on. And what you're going to find is that those places are not going to be able to compete. We've already seen, for instance, some coal power plants basically pumping up in India, etc., to try and compensate for that. China basically is also looking to do other, alternative measures. Pakistan, I think, is going through rolling blackouts at the moment, so that's going to be a story that goes forward. Also, we've had the first collapse that we predicted a while back in Sri Lanka. A number of other countries are also looking in a precarious position. Pakistan, like I mentioned, Ghana, Peru, a number of places that have had inflation riots and other protests recently. So watch out for those news as well. So that's it for the moment. Thanks for joining us, and I'll speak to you guys again next week. Cheers.